Hey there everyone, welcome back to another video. Today we are going to be looking at chapter 39 of IGCSE Economics, which is the current account of balance of payments. So without any further ado, let's get started. Now, you'll firstly notice that I've underlined current account in the title. And why is that? Is because the balance of payments itself includes three main things: the current account, the financial account, and the capital account. But because the current account holds the majority or is the largest component of the balance of payments, that is the only thing that we are going to be focusing on for IGCSE economics. That is why whenever you get a question on it on balance of payment or anything or current account of balance of payment, it's very important that you say that this of current account of balance of payments and not just balance of payments. Because when you talk about balance of payment, that includes this, and this. Okay? So remember that. Now, definition of balance of payment, you can easily say it's the financial record of a country's transactions with the rest of the world over a given period of time. Now, when you talk about transactions, we are talking in terms of trade. Trade in what? Trade in goods and services. Okay. Now, I'm sure you know this formula where AD stands for aggregate demand, and then this is the formula which is also for economic growth. Now, when you're talking about balance of payment, this is the key thing that we are going to be talking about because this is what exports minus imports. So, if I have more exports than imports, then this will be a positive value. But if I have more imports than exports, then this would be a negative value. That will directly affect my aggregate demand or economic growth, right? So this is why we look at it in terms of this formula as well. And plus, you know that balance of payments is a macroeconomic topic. And whenever you are talking or discussing about macroeconomic topic, always remember to use this formula. You can literally answer any question on macroeconomics with this formula only. So please remember this formula and know how to use it when and in which type of questions. Okay. So I think we did this. Now, when you talk about current account, okay, current account itself has many components. So we have the trade in goods, we have the trade in services, we have the primary income, and then the secondary income. So this is net incomes, okay? So this combined together has a particular name, which we call the balance of trades. Okay, so when a question is asking in terms of balance of trades, it's talking in terms of both trade in goods and in services. Okay, so always remember that. Now, when you have a balanced current account or balance of payment or just balance of payment, okay, it sounds some way. That means that the value of your exports is going to be the same as the value of your imports. Okay. Now, if you have a balance of payment deficit, that means that the value of your exports would be less than the value of your imports. And if you have a balance of payment surplus, that means the value of your exports will be greater than the value of your imports. Now be very careful. Look over here. Let me change the color. Right. Yeah. You'll see that over here, I always added a V. Okay? A V here, here, and here. Now why? Because we are always talking about value of the goods, okay? The value of the trade that you're doing, not just this. So if you're going to say that but if the question asks what is balance of payment surplus, if you say imports are greater than exports greater than imports, that will probably not get you all the marks that you're looking for. You have to mention value of things. Okay, now balance of payment can also be referred in three different terms. Okay, you can talk about it in terms of credit items or debit items. Over here, credit stands for exports and debit stands for imports. So for example, if I was defining balance of payment surplus, I could say that when the value of credit items is greater than the value of debit items. That's one way. Now, another way is the value that we talked about, the V, and we can also talk about revenue. Balance of payment surplus, for example, again, we could say when the revenue from the exports is greater than the revenue from the imports. Okay, that's also one way we could definitely describe it. Let me just check something real quick. Um, all right, yeah, that's good. Now, that was about balance of payments. Now we'll be looking at specifically, wait, just a second over here. When I talked about revenue, right? Revenue, when you're talking about balance of payment in terms of revenue, it's revenue of the exports and expenditure of the imports. I think I forgot to mention that in this thing. So let me write it here. So when you're talking about revenue, that's in terms of exports and expenditure, which is in terms of imports. Okay, please remember that. Now we are done with balance of payment. We'll come to current account. Okay. Now, as we said, trade balance, okay, includes what? Trade in goods and trade in services. Now, when you're talking about trade, right? Trade is not between trade. Trade is going to be between two things or two countries. Okay. So it's going to be involving both the imports and the exports. Okay. So we have trade in goods, which is also known as the visible balance. It is the trade of visible goods or merchandise. Now, visible goods such as raw materials, manufactured goods, these are tangible items or physical items that you can touch. For example, it could be car, food, etc. Okay, because these are visible items or goods that you can see. Now, when you talk in terms of services, you know the difference between goods and services, right? So trade in services is also known as invisible balance. Okay, so it's the trade of invisible goods, goods that you cannot see. So these are basically services. What are invisible goods? Invisible goods are basically services, right? So these include teaching, tourism, banking, insurance, etc. Again, trade means both the imports and the exports of all these that we mentioned over here. Now, the third component, which is the primary income, is also known as investment income. Now, this is the country's net income earned from investments abroad. Now, this could include something like profits from subsidiary companies based in overseas markets, remittances, you could also have interest received from loans and deposits in overseas bank, dividends earned from financial investment in overseas companies, FDI of individuals or businesses in overseas business ventures. So over here, keyword is going to be overseas, right? Or abroad. Remember that. Coming to secondary income is free. It's something that you do not pay back. So something like gifts, okay? So these are transfers arriving from financial gifts between residents of different countries. Now, let's say, for example, there's a flood in, I don't know, a random country, let's say Ghana, okay? And India sends financial aid or maybe medical equipment and all that as a gift, then that becomes the secondary income of Ghana. Okay, so that's importing of this one, those goods. So these include donations, scholarships, and foreign aid. We have more. We have payments of pensions to retired people now based in overseas countries and etc. Now, hence, we can say that current account is made up of what? Balance of trade. We know trade consists of both goods and services, primary income, and secondary income. Great. So now we are done with the first part. Now let's move on to the second part, which you have to pay very close attention to because this is where your most questions are going to come from this chapter. Now, first of all, we'll begin with current account deficit. Now, how would you define deficit? You can say that the value of exports is less than the value of imports, or you could say that the value of exports is the same, but the value of imports has now increased. Or you could say that the value of exports has increased a little, but the value of exports has increased a little, and the value of imports has increased more. Or you could say that the value of exports has decreased, but the value of imports remained the same. Or you could also say value of exports has decreased way more than the decrease in the value of imports. Now, these are all possible things that could cause current account deficit. So, which is why you need to know that this is not the only thing that causes current account deficit. All these can cause current account deficits. And once you remember all these, you can answer almost all questions in the question paper. Now, I've added a key here. This is exports and this is imports. Now, when you're talking about causes of current account deficit, right, it's going to be caused by two things, and there are multiple ways of describing these two things. Now, what are these two things? First, there will be lower demand for your exports, or there could be higher demand for your imports. Now, the way you decide to explain this will determine how much marks and everything you get. Okay, you could have the same main idea defined and described in different ways, and they could be correct and they could be given the marks. For example, over here, let's say that the quality of exports increase. Now, if quality of exports increase, then the demand in the domestic market for them will increase, wouldn't it? Then if we have a currency appreciation means that imports will become cheaper, which will again increase demand in domestic economy, or you could also explain it as since exports will become expensive, demand of exports will decrease. Oops, did I do anything? Never mind. Exports could become cheaper. Now, you could explain different ways how exports could become cheaper. In the foreign country, you could say maybe there's increase in skilled workers, increase in technology, and all those, which will increase the demand in the country that you're there. You could have inflation in the international markets. Um, no, no, no. I think I meant to say inflation in the domestic, rather. Sorry. Inflation in the domestic markets, which causes exports to become expensive, which causes them to become internationally uncompetitive. Now, this point over here can also be explained why, because this shows that my exports are change the color. My exports are decreasing, while my imports are the same, which is still going to cause the deficit, right? So this is how you could explain it. Different points you could make mention. Now, the consequences of current account deficit is what? You know this formula again. Let me change the color. Yeah, aggregate demand or economic growth. If my deficit means if this is going to decrease, that means that my economic growth will decrease, my aggregate demand will decrease. Okay, now again, as I said, once you have this formula, you could literally answer any macroeconomic question. Oops. So let's look over here. There could be reduced demand, which causes recession, cyclical unemployment, lower standard of living, increased borrowing, lower exchange rate, leading to imported inflation. Now, I don't want to explain this to make the video too long, so just go and read the textbook, which has it explained in very great detail. Now, everything would be the opposite for current account surplus, okay? Let me still explain it. Now, causes of current account surplus could be why higher labor productivity, which could be maybe due to increase in manufacturing competitiveness and other factors. Now, what will this do? This will increase the quality and other things of my exports, right? So my demand for exports would increase compared to my imports, which is what would lead to the current account surplus. Now, there could be higher incomes in the overseas market. People will be getting richer in other countries, so they would be willing to buy more of your product. So that's something you could talk about. There could be depreciation, which would cause exports to become cheaper. Now, again, consequences, you could have increased employment because your exports are increasing, which could increase incomes, which should increase standard of living. Demand pull inflation could be caused by exports in other countries. Appreciation, as the demand for exports is increased. So, as you see, everything in economics is linked to one another. You just have to find out how it links to each other and have a story in mind, okay, that you can always remember. So that'll be all for this chapter. I know policies are also included, but these are something I would want to cover in specific chapters of each of these, which will be coming out soon. That's all for this video. Thank you for watching. I hope to see you in the next video. Like, share, and subscribe. Till then, tada.